Well, the year 2020 has certainly been an interesting one, especially for stock market investors. For example, the US market in 2020 started the year up 5% in just 45 days. And then in the next 40 days, 3 entire years of stock market gains were erased for the S&P 500, representing a decline of over 35%. And from there, many people expected that the US market and many other stock markets around the world would continue to decline or worsen over the remainder of 2020 because of the state of the real economy, the real businesses and individuals who were struggling on a personal and business level. But what happened instead is the US market pretty much went up in a straight line about 60% over the following few months. Pretty unbelievably, this put the US market at its all-time high just a couple of weeks ago, and over the past 2 weeks, the markets have been coming down. So this has left many investors very, very confused about what to expect over the remainder of the year and beyond. So in today's video, I'm going to break down whether I think that there will be another crash, a second crash towards the end of 2020, but more importantly, how you as a retail investor, as an individual investor, can better position yourself for success in the markets in 2020 and beyond. If you enjoyed today's video and get some value out of it, all that I ask from you is if you could take the 2 seconds it takes to leave a like on the video and let me know your thoughts down in the comment section below. But for now, let's jump into the video. So before I get into talking about whether I think there will be another crash, I first want to talk about why I think the markets rebounded so quickly out of what happened in March and April, where the markets declined in one of the fastest crashes that the US stock market and global markets have ever seen in their histories. To the average person who is seeing what is happening around the world in terms of this pandemic and the real impact that it's having on businesses and individuals, it doesn't really make any sense why the US market is sitting up near its all-time highs. And the confusion that you might have about the gap between the stock market and the real economy is also supported in the numbers. The economic activity is just down. People are spending less. People are saving more. People are using money to pay down debts that they have accrued over the past few years. Economic activity is down and many businesses are really struggling. And while there's really no way that we can pinpoint exactly what caused the markets to rebound so quickly and at the magnitude that it did, we can look at some economic factors that may have contributed to why the markets rebounded so substantially. And one of those key factors or key drivers is the change in the Federal Reserve's monetary policy. To give you the headlines as to what the Federal Reserve is doing at the moment is they are doing a lot of quantitative easing, which is the purchasing of financial assets with money that the Federal Reserve prints, and they are also keeping interest rates at zero or near zero for the foreseeable future. In fact, many people are estimating that interest rates in the US will stay as low as near zero for as long as till 2023. And as an individual investor, it's super important that you understand the impact that interest rates have on stock prices, how they impact the prices that stocks have in the market, and how that might have contributed to a significant upward movement over the past few months, and how that could change over the next year and beyond. The way that you should think about this is in terms of opportunity cost. What are the alternative investments that are available to investors, right? And we can compare things on 2 ends of the extreme: risky assets such as stocks at one end of the extreme, and really safe assets such as buying government bonds or something that's pretty much as close to buying government bonds now, which is putting your money in a high interest savings account or some kind of CD. What you will notice when interest rates are near zero like they are now is the savings accounts that banks are offering you are also offering interest rates near zero. They're offering you a very small amount of interest for you to deposit money in those savings accounts, or even to lock it away in a term deposit for 6 or 12 months. For example, in Australia, interest rates as well as in the US are near zero, and the high interest savings accounts that are available to us at the moment are offering returns between 0.5% and 1%. So very, very low. And what people do when the safe investment opportunities, such as putting money in a savings account or investing in treasury bonds, in government bonds, what people do when those are offering really, really low returns is they look for alternative investments, such as investing in the stock market. And when your savings account or safe risk-free or near risk-free assets are offering 0% or 0.5% or 1% returns, people are willing to accept pretty low but slightly higher returns in the stock market, maybe something like 3 to 5%, right? If your savings account is getting 0.5%, you're probably pretty happy if you can make a 5% long-term return on a stock over the next 10 years. So to demonstrate this, I'm going to show you an example of a discounted cash flow of a company, which is a way of valuing a company, a way of figuring out what price to pay for that business. And I'm going to show you the difference in the price that you're willing to pay depending on what kind of return you're willing to accept, whether it's 10% or whether it's 5%. So if we take Facebook, for example, and we put our required rate of return, which is our target return, at 10%, you can see that based on these models, the buy price is somewhere between $230 per share and $400 per share. Now, if we lower this to 5%, meaning if you're willing to accept a 5% return on Facebook instead of a 10% return, the price you're willing to pay goes up to $340 per share, all the way up to $606 per share. Now, those specific numbers that I've used for Facebook are just for example purposes. It's not a real analysis, but what you can see is when you're willing to accept a lower return, what you're really saying is you're willing to pay more for that asset. And what that does on a broad basis is when alternative investments like US government bonds or savings accounts, other assets, when they're offering really, really low returns, people are willing to accept lower returns in stocks and therefore are willing to pay more for those stocks, and that drives up asset prices. So that's one factor that could be driving up asset prices. But ultimately, when we're looking at economic factors broadly, it's going to be near impossible to figure out what is actually driving the movements of stock prices over the long term. And it's also even further near impossible to predict what is going to happen in the future. And Warren Buffett famously puts these kinds of analysis into the category of important but unknowable. So it's important because it does have a real impact on your returns over the long term, but it's not knowable. So it's not sort of worth spending time trying to figure out what has caused the stock market to go up. It's ultimately probably going to be a combination of a number of unpredictable factors. And that might sound really negative, as if we have no control over our investments. But the good thing is that as an average investor, you really don't need to be able to predict all of these economic factors in order to have success in the market. So as I promised, towards the end of this video, I will be showing you how you can position yourself in the stock market for success in 2020, regardless of what happens over the next few months. But before we get to that, I want to talk about some of the key reasons why many prominent investors at the moment believe that we will see another crash over the next few months towards the end of 2020. The first reason is that many people believe that the stock market, broadly speaking, is overvalued, which essentially means that there is a divergence between the prices of stocks and the real profits that those businesses are producing. At the moment, most stocks are priced as if their profits are just going to go back to pre-pandemic levels almost immediately, within the next 6 or 12 months. And for other types of businesses that really didn't see much of a crash, investors seem to be just expecting that there's going to be no or near no decline in their profits, and they will just continue to grow their profits immediately. And that gap between stock prices and the profits that those businesses are actually producing today will close for one reason or another. It'll either be that stock prices come down to reflect the profits that the businesses are actually producing, or those profits will be drawn up. They will grow to reflect the prices that people are willing to pay for those investments. And this kind of divergence between those two and the possible outcomes from that situation is something that I discussed in detail in a Ray Dalio video I did a while ago. I'll leave it linked down in the description below. I highly recommend that you check that out if you want further information on that topic. But that is not the only reason why a stock market crash may happen over the next few months. Another reason is if inflation picks up, which causes the Federal Reserve in the US and in other markets to raise their interest rates. If the US, for example, sees a substantial increase in inflation, which may very well happen considering the amount of government spending that is going on at the moment, if inflation does pick up, the Federal Reserve may be forced to increase interest rates in order to stop inflation getting out of control. And if this happens, then your savings account interest rate may go from 0.5% to say 3%. And if we go back to that example that we were looking at before, now if your savings account is offering you 3%, as an investor in the stock market, you may no longer be satisfied with a 3 to 5% return. Now you may be much more interested in an 8 to 10% return, because remember, if you're putting money in the market, you're investing in risky assets. You're assuming a risk, and you should be willing to pay or receive a higher return for that added risk. So as interest rates go up, your demanding return for stock market, for other risky assets, also goes up. So again, using this Facebook example, but instead of lowering our required rate of return, if we now increase our required rate of return from 5% to 10%, you can see that the buy price goes down substantially. The price that you're willing to pay is substantially less. So just to summarize what all of this means, if interest rates go up, then your alternative investments, your safer investments are offering higher returns, and that means you are demanding higher returns on your stock market investments. That will put downward pressure on stock prices. And if you're wondering if we have a recent example of this happening, we actually saw this happen on a minor scale as recent as in 2018. In late 2018, the Federal Reserve raised interest rates from 1.5% to just 2.5%, and the result was that the stock market crashed about 18% in 3 months. Now, in this situation, inflation was low, so the Federal Reserve immediately realized what was happening and they were able to lower interest rates again. They stopped raising interest rates. But there may be a situation in the future where inflation is high and they don't have a choice. They can't lower interest rates again. They may be forced to continue to raise or keep interest rates at a high rate, which may put downward pressure on stock prices. So what do I think is going to happen? Do I think that there is going to be a stock market crash over the next few months? Do I think there's going to be high inflation and that's going to cause interest rates to rise? What do I personally think what's going to happen? Ultimately, my position is that I don't know what's going to happen. And I think if you're listening to someone who says that they know for a fact, or they're highly certain that the stock market is going to crash over the next few months, or the stock market's going to do this in the next 12 months or the next 3 months, I think if anyone's saying that, you should probably stop listening to them, because at the end of the day, there are just, as I said earlier, there are just so many factors that go into moving a broad economy or moving a broad stock market, and there are very, very few people who have studied this, studied macroeconomics over their entire lifetimes, and many of those people still have no idea how these markets work. So my position is, I really don't know what is going to happen in the short term over the next few months. And that might leave you wondering, well, if it's all so unpredictable and no one knows what's going to happen, how on earth as an individual investor are you supposed to invest with any kind of confidence? So let me show you exactly how you can invest without needing to know all of the details about all of these factors and forces behind the movements in the stock market. The first way that you can go about this is just to be a passive investor. And this is going to be suitable for probably 99% of people, maybe even 99.9% of people. And when I say be a passive investor, essentially what I'm saying is invest in an index fund or an exchange traded fund that essentially allows you to copy the market. It allows you to go along for the ride without predicting what the movements are going to be in the short term. Because while I don't know what is going to happen over the next few months in terms of the stock market or even in terms of the profitability of businesses, I do know that broadly speaking, businesses in the US and Australia, for example, will over the long term produce more profit. And the reason why is because businesses invest, they innovate, they come up with better products and services, they reduce their costs, and that has been something we've seen happen over many, many centuries of human history, is businesses improve and, broadly speaking, become more productive over time, which means if you piggyback on the back of, say, the US economy, for example, you're very likely going to do well over the long term if you just invest consistently and don't worry about trying to predict all of the bumps in the road. And I think one of the reasons why many people never invest in the stock market is because they fear that they're going to make an investment today and then tomorrow the stock market is going to fall 50%. But that's the wrong wrong way to think about it. The way that you should think about it is, we don't know what's going to happen. The market may very well drop 50% tomorrow or the day after you invest. But if you're investing consistently over time, not just that one time, then you're going to be investing when the stock market is down. You'll be investing when the stock market is flat. You'll be investing when the stock market is going up. And over the long term, your portfolio will move with the movements of the broad economy, whether that's in the US or the global economy or the Australian economy. And historically, the US and Australian markets have done between 6 and 10%, but even if you made a few percentage points above the 0.5% you can currently get in a savings account, it makes sense to put some money aside and build a portfolio over the long term, rather than just leaving it in a savings account, which is earning you practically nothing. And then for those 1% of people or 0.1% of people who want to actively manage their portfolio, then there is a way that you can do a little bit better than the market average. You can try and pick individual businesses that will do and perform better than the broad markets. And when you're picking individual businesses, you're still not trying to navigate the short-term stock market movements. You're still not trying to predict what are the factors that are driving the stock market over the next few months. You're still investing over the long term. You're just investing in the individual businesses that you think can produce you more profit than the market broadly. But if you're an active investor, the same principles apply. You're still looking for really strong, great businesses. You're looking to make an assessment between the cash flows that that business produces and the price you're willing to pay. And then you want to invest in those businesses consistently, recognizing that things like what we're experiencing right now are going to happen from time to time. And when those things happen, you should still be investing in those businesses, building your ownership in those great companies. And obviously, if you pick good companies, then you will do well over the long term. But as I said, for 99% of people, you don't even need to worry about any of that stuff. You can just invest broadly in the market, contribute consistently, and it's very likely you will do quite well over time. So that is all for today's video. And if you did enjoy today's video and you want to see more content like this, especially if you want to be an active investor and learn the details of how you can analyze a business and make successful investments that outperform the market over the long term, or provide some more consistency in your portfolio, then consider becoming a subscriber and checking out some of the other content on my channel. But other than that, I hope you guys have a great day, and I'll see you in the next video.